how to pick stocks to invest in your investment portfolio. So far on this channel, mostly we've talked about investing in the ETFs and mutual funds, which is, I believe, the best way for beginners to invest. But there is other way of investing by picking individual stocks to invest, which is considered more risky way, but it has better results if you know how to pick the stocks and you're sure about the stocks you're picking. And even Benjamin Graham in his book Intelligent Investor was telling about that picking certain stocks which are undervalued right now can help you to perform better than the market so that you will beat the market overall. And of course, this is more difficult to do if you're just an average investor who doesn't want to put a lot of efforts on investing thing to have 2, 3 and maybe 5% of return more than the market. But this is possible to do if you know how to do this. And today we'll talk especially about that topic. So first thing which comes to mind when you want to invest in individual stocks is diversification. So please be very careful with that. You don't want to select one single stock and then invest in it all of your portfolio. You want to select a variety of different stocks. For me, I just follow a rule that I don't invest more than 5% of my portfolio to the single stock. And I do not invest more than 15% of my portfolio to a certain sector. This is my general rule, which I follow for myself. So let's check out how the performance of a single stock can outperform the market, all right? So we can take a look at this graph. This is Finviz website, absolutely free, very good screener on which you can check different stocks to invest in. And this is Vanguard's S&P 500 Index ETF, which will represent the market. And if you go down, we can see that performance for the last year was 10.9%, almost 11% for the market, right? And if you take a look at common stocks that we know like Apple and Google, and let's check out them. So Google was performing for past year performance 25%. So the market was 10%, almost 11, Google is 25, so 15% more. And of course, this is good investment if you knew that this single company will perform in such a way. And basically it was predictable, right? But what is not predictable, that you cannot foresee different force major situations which can happen to basically any company, even good company, and even if that company is undervalued. That is why we don't want to put all of our investment to a single stock. Let's check out Apple stock. Right, so Apple stock was performing for the last year for 36%. So it has grew for 36% for the last year. So today is April 6th. And since April 6, 2021 until today, April 6, 2022, Apple stock has grown for 36%. And this is completely more than the average on the market, even more than the Google, which had 15% more than the average, but Apple has grown even more than that. And this is huge company, right? This is the largest company in the world, which has $2.9 trillion market capitalization, and to grow up for 36%, this is huge amounts of money, right? And let's take a look at another company. Facebook is also a big company, right, with a capitalization of $624 billion at the moment, before it was higher, and it's in the index S&P 500. And as you can see here, there is a small thing, right? Booms, it goes down. And what happened here? At this moment, in the February, Facebook released its earnings report, right? And in that earnings report, Facebook was basically saying, or Meta, how it's called now, that they are not waiting for new users to arrive on their platforms like Instagram and Facebook in that quantities as it was expected. And they're also saying that they're spending money for metaverse, but still not receiving any profits from there. And therefore, people just thought that, all right, we don't want to invest in this company. And as you can see, Facebook has performed for the last year minus 25%. but it's also a good company, right? Nothing actually happens to the company. They just released their report, but the company itself is completely the same. Nothing happened overnight, right, to the company. And that is why you want to consider into investing in variety of stocks. Not just a single stock, even if it's a good one, but a bunch of different good stocks. That is called diversification, right? And interesting thing about Facebook company that if we scroll down here on Finviz, then we can see that down, right? Here, we can see the operations made by the insiders, means by the founders, by the CEO, and we can see here that Mark Zuckerberg has been making sales for the last year, like at least since September 21st. Every day he was selling shares of Facebook, right? For the total amount of $27 million every day, all right? So he was making the sales every day, right? October, November, December, January, February. So what we can understand from that probably Mark knew that they're gonna release such report, which will influence badly on Facebook company. And of course, he wanted to sell the shares which he was owing for the price as much as possible. And basically that's what he did. And as you can see, the price of Meta has decreased for 25% for the last year. That's quite interesting things to look at. All right, let's get back to how to pick individual stocks. And the first thing which I take a look at is the debts of the company, all right? Nothing else but the debts. If the company is not having debts, then it will not die, all right? And after that, I look at the profits. If the company not having debts and still having profits, it means that it will not die and still will generate some money for you as investor if you're holding shares of that company, right? And then I look at the dividends, and if all of the above is okay and I'm okay with that, then I look at the valuation of the company in relation to the market, and then I look at the entry point, if it's a good point to enter that certain company right now. So let's start with debts. Here in Finviz we have a bunch of ratios, and the first thing which I actually look at are the ratios, right? And then after looking at all of the ratios, I even dive deeper and go to the financials of the company. But I think today we will not take a look at the financials because it will be quite a long video anyway. So we'll concentrate on the ratios because they just give you a footprint of everything which is going on with the company right now. The debts here are expressed in quick ratio, in current ratio, debts to equity ratio, and long-term debts to equity. These are the four things which I look at to see what are the debts of a certain company. So quick ratio is generally how company is able to cope with current liabilities, all right? And preferably for me, it should be more than one. If quick ratio is more than one, it means that company is able to pay its current debts and liabilities at this moment right now. So the current ratio is almost the same as quick ratio, and then the debt to equity, so assets are equities and liabilities. So here we can see that the debt to equity relation is 0.06. This is perfect, and generally for me it should be like less than 2. If it's less than 2 debt to equity ratio, then I'm good with that company. But of course it's not a rule of thumb, and it depends on what the company is. If the company is paying high dividends, for example, then usually they have higher debts. But for now we're looking at the Google company, Alphabet, and they're not having any debts, but they do not pay any dividends as well. Then we look at the long-term debts, and it's basically a combination of current debts and long-term debts. And it's also, for me, should be less than 2. So Alphabet company is absolutely good for me when it comes to debts. This company doesn't have debts, right? Then the next thing I want to check is the profitability of the company. I want to check if it's making profits. We already made sure that this company is not going to die soon. Let's see how much profit it's generating, right? So the profit here is expressed in these numbers. The earnings per share past 5 years, this is what I look at. Sales past 5 years, then sales quarter to quarter, EPS quarter to quarter, can also take a look at that. And also I look at gross margin, operating margin, and profit margin. These are the things which I look at when it comes to profit. So EPS past 5 years. This is basically the earnings per share rate of growth, right? So it's not the momentary thing, but it's 5-year growth of that earnings per share. And we can see that on the average for the last 5 years, it has been increasing for 32%, which is super good for us. So sales past 5 years. Sales is generally how much company was making revenue, and it's increase every next year for past 5 years. And we can see that average increase rate was 23%. This is also good. We want all of them be at least more than 5% every year, right? And here is 32 and 23. This is super good result for us. Then we look at the margins. Gross margin here is 56%, operating margin is 30%, and then it decreasing to final, the profit margin, the bottom line is 29%. What are all that margins? It's basically, so if we look at the profit margin, this is the bottom line, right? And it's relation of how much company has made profits in relation to its revenue. So the revenue is the top line of the company's income statement. Then we deduct appreciation, devaluation, we pay taxes from that, then we pay cost of goods from that revenue, and then in the end we have profit. And then the profit margin is relation of the profit number to the revenue. And we can see that 29%, almost 30%, this is pretty good number for profit margin. And basically such a high numbers of profit margins are typical for IT companies, right? And it's not typical for oil and gas companies or material companies. There you'll have profit margin much less, maybe 5%, but for us it should be at least more than 10%, right? So that we know that this company is generating profit. And yeah, by the way, make sure you are subscribed to this channel, because I will post videos that will help you to improve your knowledge. So it's better for you and for me as well. And I will thank you for that. Let's go. Alright, the next thing which I want to check when I'm estimating the company, whether I want to put it to my portfolio or not, is whether the company is paying dividends or not. And if it's paying, then the first thing which I want to look at, for example, the Google is not paying any dividends. That's why we'll go to Apple and see what are things with Apple dividends there. We can see that the dividends they pay is 0.5%, right? This is not much. These are growing dividends. And the next thing which we want to take a look at is the payout ratio right here. You can see here, payout. And we can see that it's 14.2%. What does that mean? It means that the Apple company is paying you dividends, and that dividends are coming from the profits, right? Which that company is generating. And in case of this company of Apple, the amount of dividends they pay to the all shareholders of Apple is 14% of the profit that they are generating. And this is not much, because especially companies like dividend aristocrats sometimes pay dividends even if they do not have income. So basically they take a loan, they have a big debt to pay off that dividends. And the dividend aristocrats, by the way, are the companies which are paying dividends and every year increasing the amount of that dividends for the past 25 years, all right? And as you can understand, for past 25 years, there were bad years for many of the companies, there were many crises, and therefore some of companies had to pay these dividends just to remain an aristocrat, so that people know that they're paying dividends even in the times of crisis. And this is the next thing which we want to check when we're assessing some company for dividends, is whether that company was paying dividends in the times of crisis, like for example 2008, 2009. 2020 and different crises. And basically we want to check out the history of the dividends. So you can check out that information on websites like Yahoo Finance or Rocket Finance. And for example, the Coca-Cola company, which is dividend aristocrat, means it was paying dividends for the past 25 years and even increasing that dividends every year. And we can go to the, for example, on the Rocket Finance, to the cash flow statements of that company and check out that cash dividends paid and the history of that payment, right? So we can see that at least since 2014, this company was paying its dividends stable way. And we can check out all the rest of the companies that we want to look at in the same way. And the question of whether you want to have in your portfolio stock that pays you dividends or not is even a question of your strategy, of your investing strategy. For example, some people want to have the stocks in their portfolio so that they can right now leave all the dividends, right? Some of the people want to invest in growth stocks which are not paying dividends, like Google, for example, because they reinvest all that money from the profits they're making back to the company to expand its operations, to improve the company, to make some restorations and to build even more buildings and etc. But some of the companies like Coca-Cola, they do not have room for expanding, right? They do not have room for improving. It's already settled, and therefore the price of the Coca-Cola stock cannot increase that much, cannot grow that much because of new investment coming there. And that is why Coca-Cola, for example, is paying dividends already for such a long time to attract investors to hold shares of that company, right? Alright then, after we checked that the company has no debts or low debts, that it has profits, that is okay for us, that the company is paying dividends and it's not coming to the damage of that company, or if it's not paying dividends and we're okay with that because that is our strategy of investing, we can go ahead and check the valuation of that company. And so the valuation for this Apple stock, for example, will consist, for me personally, for this block right here, right? Price to earnings, forward price to earnings to growth, price to book value, price to sales, and etc. But most common thing is price to earnings ratio, right? And generally, if you are confused with what are all of these ratios mean and exactly for this website, then here in Finviz you can go to here help tab, for example, and it says here what all of these ratios for this exact website mean. For example, if you go down here, down, right here, price to earnings ratio, right? This is the way exactly Finviz is calculating those ratios, because different websites and different sources may give you different information. For example, if you go to Investopedia, they can tell you the theoretical calculation of different ratios, right? But here is the practical ones and exactly how this specific website is making different calculations. And thing you want to pay attention here is the time period. For example, here is the sum of 15-year earnings per share. You want to check out how big time frame the Finviz is taking for calculation of these ratios. This is very important, not just to look at the numbers right now in their static way, but to look them on a dynamic way. But for that, I basically go to the financial tabs for Rocket Finance or Yahoo Finance and look the dynamic numbers of certain stock. Here basically I look at the static numbers except these EPS and sales past 5 years. Price to earnings ratio for Apple stock, for example, is 29. It means that the company with a capitalization of $2.9 trillion is generating some profit, and the relation of that profit for 1 year to the total price of the company is expressed here in price to earnings ratio. What does it tell to us? We want to compare this number 29 to the average of the IT sector. So you can see that Apple is located in the technology sector. So you want to compare this number to the average in the technology sector. Going to the groups right here and valuation, right? And you can see here that the technology sector average price to earnings ratio is 31.9. So 32 almost, right? And Apple is 29. It means that Apple stock is a little bit undervalued to the average of that sector. And generally you can see that the price to earnings ratio for tech sector, for example, or for communications like Facebook and Google is higher than, for example, basic materials, right? Or energy sector, right? Or financial sector. This is because such high-tech companies do not have many buildings, do not have many physical objects which are evaluated here, but they have something on the internet, in the IT, some digital products. And therefore, the price to earnings ratio of such tech companies is higher than for companies from basic materials sector or from energy sector. And the other thing which I often take a look here is price to earnings to growth ratio. Basically, it's the same ratio what we checked out before, but it takes into account the annual growth of this specific company for past 3 to 5 years. For me, this price to equity to growth should be ideally less than 1. If it's less than 1, then this is definitely a good company which has big potential to grow. It's not certainly will grow next year or even next few years, but if you're a long-term investor, then you're holding that stock and you definitely know that that company will explode at a certain moment because it has super big potential. If it's matching all the previous criteria that we checked out today, it doesn't have too many debts, it's generating good profits, and it has good dividends, and the valuation of that company is good now, then it's definitely a super good pick for us to our portfolio. And this is all provided that we are following the diversification, right, which I told in the beginning. And the final thing which you want to check out, for example, if you already know that that specific stock is good for you to choose in your portfolio, then you want to see if it's a good moment to buy that stock right now, or if the company is a little bit overbought or oversold and you want to wait and put it to the watch list and to look at when it will be better for the better price, or you want to buy it right now. So how I am checking the entry point of certain stock is I'm going to this TradingView website, right? And I'm going here to the indicators and I want to check out the relative strength index, or RSI, right? Then we close it. So after we chose this relative strength index, it will be indicated here at the bottom of our stock's price. And we can see that currently it's 42. And what does that mean? Basically, relative strength index is relation of how many people are willing to buy that stock in relation to how many people are willing to sell that stock. And if this is low, for example, like lower than 50, then more people right now are selling that stock. And if it's less than 30, then it's definitely a good moment for you to buy that stock because it's oversold right now at the moment. But you should also take a look at the price to earnings ratio, because even if the company is oversold right now, but price to earnings ratio is still high, it means that people are just selling, but the valuation is still high. Then you want to wait with buying of that company. And the same if the relative strength index is too high, like more than 70, then most of the investors right now are willing to buy and buying this stock. And maybe it's not a good moment for you to enter this position and you want to put this company in the watch list and wait until later when this relative strength index will be lower for you to buy at the good entry point for that price. That's it. I hope this video was interesting and useful for you guys. Please subscribe, it really helps me and my small channel to grow, and thanks for watching. See you in the next video.